Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi. I'm on the bash as well on the show. And we managed to eke out okay. You know, we were range bound. We were in a narrow band. While we may have closed off the day's highs, we managed to circle around that 17,650 or thereabouts for the better part of yesterday's trading session. Yes, we've slipped below the support mark of 17,700 and we've seen a fall for a second consecutive day. But PSU banks, they continue to remain on a strong footing, and yesterday was no exception, with the likes of SBI still leading from the front and a whole host of other smaller PSU banks as well. In terms of a global handover, the US markets have been largely flat amid earnings, which have been coming in thick and fast. So absolutely a flat close for the Dow, and ditto was the case across the board pretty much. The FIIs, they continue to be in a bit of a buying spree, although yesterday was a sell figure. Having said that, across the global markets, you've seen pretty much a quietish move. The SGX Nifty as well, pretty much in line with what the rest of the globe is doing, is indicating an absolutely flat start. And that's pretty much the call on India markets as well. Amid the thick of earnings, while two majors from the IT sector are already done with, two biggies are yet to go. And unfortunately, it's only going to be post-Friday on market hours, Reliance on Friday evening and then ICICI Bank on Saturday. So up until then, it seems we're going to fall prey just to what the global markets have done and be pretty sideways and range bound, Aman.
Absolutely. We will be watching out very closely for those earnings, but just to even give you a sense as to what the kind of liquidity situation has been in terms of the FII data as well. You did have a net sell figure that has continued 2 straight days on the chart, close to 800 crores FII net sell figure just yesterday at about 810 crore rupees, and this is with a DII buying number of about 400 odd crores. So that's the liquidity picture. That's how we shaped up in yesterday's trading day as we slipped below that support of 17,700. 2 straight days on the chart that we buckled under pressure. But that one shining spot or that comeback sector that we are noticing is clearly the pharma sector. That seems to be on quite a tear. Interestingly, it's been the top gainer in yesterday's trading session. You had across the board names within the entire pharma basket that did manage to hold out. So check in on stocks like Lupin, for instance, or Biocon, Divi's Labs, Glenmark, Granules, Cipla across the board. And you also have the index, which has topped the 200 daily moving average level. From the kind of lows that we saw just this year, you've already seen a pullback of close to 9% for the pharma space as a whole. And what you're seeing on your screen as well is the kind of delivery data as well that we've witnessed for a lot of these pharma stocks. They have been quite active. Looking at the overall valuation picture on an FY24 PE valuation basis, it is a little bit expensive, but around 22 times, for instance, for a Lupin, Cipla at about 23 times. You've got some of the other mid-cap names like an Abbott, for instance, where valuations are quite compelling at about 38 times. But clearly, Aisha, seeing that sort of a comeback, especially from the lows that we witnessed this year, the pharma sector has been a standout.
It has been, and it's been an underperformer as well, and a ranked one at that, all through 2022, right? So yes, finally some buying coming in for pharmaceuticals, while you definitely had DRL and Cipla, which were the outliers within the rest of the pharma pack, which are underperformed, and now most of the others are beginning to catch up. But lots of global data points and lot of global opinion as well coming in overnight. So let me take it across to Anisha and find out what the commentary has been like. Anisha?
Well, fresh commentary coming in from a couple of US Fed members, and the commentary was more on the hawkish side. First up, coming in from the St. Louis President James Bullard, when he says that Wall Street recession forecasts in 2023 are wrong. He's not expecting a material slowdown when it comes to the US economy, and hence a case has to be made for more rate up hikes going forward. So that's the word coming in as far as James Bullard is concerned. Separately, if you look at the commentary coming in from Atlanta Federal Reserve President Bostic as well, he said that one more rate hike is definitely something which is needed. The quantum of it will depend perhaps on the data points and the macro, data points that they get. But for now, at least one more rate hike is what the street should work with. ECB chief economist also said that he's also backing a further interest rate hike coming in at ECB's next meeting, and again talking about how the rate quantum will depend upon the data points as well. Peter Schiff, however, believes we'll be lucky if we escape just with a recession. He's saying recession is a given as far as the economic setup is concerned, and he expects it might worsen as well. So important commentary there coming in from Peter Schiff as well. And lastly, we have Tim Cook, who's in India, and he's talking about how the GDP growth is likely to be quite stellar. He's quite excited about India because the people is something that he really likes, the drive of the people as well as culture, and he believes that the GDP growth is likely to be quite impressive for India going forward. So that's the thumbs up coming in from Tim Cook as well.
All right, and a lot more excitement from Tim Cook as well with the newly launched Apple Store. But thanks, Anisha, for giving us a heads up as to what some of the top global commentators had to say. Well, back home then, let's hear it out from Milind Karmakar, the director and fund manager at Dalal Brocha and Brocha Portfolio Managers. He said that he expects a phenomenal boom in the consumption space and shares his outlook on the apparel market as well.
I have not been able to identify something which will go 40, 50 times, but I think anything to do with consumption. And the reason I'll tell you, I do believe that overall the per capita income can move from $2,500 to roughly about $5,000, $6,000. And if that happens, the boom in consumption can be phenomenal. So I would still continue to identify companies in consumption which can do very well going forward. So I'm not saying that like last time market may go up 6, 7 times. We have already gone, we have doubled ourselves. So maybe a double again from here, possibility. But within that, which will go up 5, 6 times as of now, I think if one wants to take a bet, it would be in consumption.
Most of the consumption stocks are trading at P multiples which are north of 50.
Absolutely.
That's the benchmark.
Absolutely.
History, since we are examining history here,
Yeah.
historically when P multiples have gone to north of 50, the future returns are always compromised.
Right.
So why do you think history this time will not play for consumer stocks?
Okay. I'll give you an example in apparel. I think overall apparel market in India is about 7 lakh crores. And there is a 8 to 9% growth in the apparel market year on year. So that means about a 60,000 crore rupees growth is there in the market. If you add the sales of all the organized retail, it still doesn't add up to 60,000. So that is the opportunity. So if the opportunity is large, these companies can grow at 35, 40% year on year for next 10, 15 years also. And that is the reason why the P multiples may not contract, but at the same time, those 50, 60 times seems to be difficult.
So for the organized apparel market, and there are a handful of players here,
Yeah.
do you see them growing individually at 20% for next 3 to 5 years?
Yes, definitely, definitely.
Which means if you are looking at buying some of these listed apparel stocks now, and we'll talk about the themes apart from apparel, if you're buying them even at these P multiples of 50 plus, if the earnings growth is 15 to 20%, they can still give you a stock market return of 15 to 20% in 3 to 5 years.
Definitely.
Which
Because
is-
the P's will continue to be high.
But if you're looking at a market which could be as vibrant as what we've seen between 2003 and 2008,
Yes.
then isn't it time to identify real big multi-baggers? Because 20%, 30%, some would say, may
fair
not
enough.
be the best return in this
Fair
kind
enough.
of
I mean,
scenario.
that's the whole game, right? To identify multi-baggers and to hold on to it during this boom. So we are still trying to do it. And I keep my fingers crossed saying that I should be able to identify at least 1 or 2 because that's more than sufficient. So we're still trying,
what
but
is
it
the
would be in consumption game. That is definite. The space will be consumption.
All right, now what should one do in terms of the current market setup? We've had 2 days of little bit of numbness. Has the tide really turned? A. B, if the tide has not turned, is this a good decline to really pad up and to revisit stocks if you missed the initial part of the rally? C.A. Rudramudri joins us. Kunal Batra also joins us. Kunal, you're joining us from your house, not in a studio. Why is that?
Yeah, Nikunj, some important work to be pending, so that's why.
Okay. So what should one do? 2 days of decline, is this market giving a great entry point again?
Well, absolutely, Nikunj. I think last 2 days we've seen a bit of a speed break on the indices because we had almost 8 or 9 consecutive sessions of uptrend for the index. Prior to that, we moved on from 17,000 to 17,800, and it's bound to be that the markets hit some sort of a pit stop before we try and accelerate and get onto the up move. And that's happened with many instances, like example the take on Infosys results and how the index reacted a couple of days back. Yesterday also was a very similar kind of a texture for the markets, where we opened at the day's high and then we closed very closer to the lows of the day. But I think we're still protecting the 17,500 to 600 zone. So in fact, technically, these are two very key support points for the index. Now, even if these supports break on an intraday basis, I would still believe that that's actually an opportunity for short-term traders to try and enter into the market. So 17,600, I believe, is a very strong support zone for the index. The other data point, which is also very intriguing, for example, the open interest, reduction. So what's actually happened is that there's been a dramatic reduction in the open interest for Bank Nifty futures. In fact, even on a day like yesterday, where the Nifty was down and the Bank Nifty was a bit more flattish, there was an 8% drop in the OI for Bank Nifty, and there was a 1% drop in the OI for Nifty, which means that the market participants are actually looking out for building more long positions on the Nifty futures as compared to Bank Nifty. So dips should be taken as an advantage. 17,600 could be a very good entry point. We tested those levels yesterday, and that should be a zone where traders should look to initiate fresh longs on the index.
Right. Rudra, hi, morning. What is your own take? Friday, Saturday, crucial days for earnings, although post-market hours, you think the markets are going to be sideways up until then?
Yeah, very good morning, Aisha. See, for me, what last 2 days of trading action indicates is we made a very swift and a fast move in just last 9 trading session, where Nifty went up close to 1,000 points. Now we are seeing some amount of profit booking, some amount of that mean reversion trade which is happening. But I am still of a strong belief that this market has now turned into buy on dip market and definitely not a sell on rise market. You have to be stock specific and even sector specific, especially if you look at now sectors like real estate, or even sectors if you look at like automobile, pharma, for example, they are doing very, very good. So for me, at current levels, you can't go and buy banks because you have already seen huge outperformance, and you have to wait out if you want to pick up banks for trading. But however, I see great opportunity, especially in pharma. Also, I see great opportunity to buy in automobile. Stock specific, we have a lot of opportunity. So for me, this is a buy on dip market. Nifty holds strong support at around 17,500 to 550 zone on futures. And if I see Bank Nifty future, I feel we are headed for some amount of decent profit booking and correction, and I want to enter banks later. Let us also watch out for what will come out from ICICI Bank this weekend and then take a call. You will get a clarity whether HDFC Bank was the NIMS whatever came was one-off, or is it continuing with even other private banks. So I will avoid banks for very short term as a trader. Look at picking stocks either from pharma or from real estate.
Let's get stock specific then with our guest. Rudra, we'll come to you maybe for those pharma picks, but in the meantime, Kunal, what's on your radar?
So I'm betting on individual names. So over the last couple of days, we've highlighted many individual themes. So 2 buy calls on separate themes. First one is from the railways pack. It's about IRCTC. I think the stock is likely to make a very strong comeback for itself. We've seen a very steady kind of a price volume action for IRCTC in the last 3 or 4 days, from 575 to now 600 plus levels, where the stock closed yesterday. Looks extremely attractive on the short-term chart, so would suggest a buy. 630 as a near-term target. Stop loss could be kept at 587. And the second would be a buy on Poonawalla FinCorp. Again, a classical chart, because the stock formed an inverted head and shoulder pattern on the daily time frame, confirmed a breakout above the 300 levels. yesterday closed just near to that 310 odd mark. I would believe more acceleration could be seen for the stock over the near term. 325 could be a revised target for Poonawalla FinCorp and stop loss at 296.
Continuing to bet on Poonawalla FinCorp, IRCTC is the other bet. Rudra, what are your recommendations? Any pharma stocks on the radar?
Yeah, my first pick is from Pharma only. In fact, all pharma stocks, most of them look very good, whether you take Sun Pharma or even if you want to pick up Cipla. But I am picking a good mid-cap stock available in F&O and I have long positions in it. So Granules is a stock which looks very strong to me. Look at the chart pattern. Between 280 to 300, it has made a very, very good sound consolidation. Accumulation patterns are clearly visible, and now it is making that breakout above levels of around 300 to 305 zone. Once it breaks this 300 to 305 zone and having consolidated for a very long time, I see a big momentum move coming in Granules. Initial targets of 330 on this stock, and eventually I see even 370 to 400 to come on Granules over a medium term. Available in futures, one can ride long positionally on Granules. DLF is another stock which looks very, very strong for me. In fact, between Godrej Property as well as DLF, I have picked DLF. For me, I have waited for long to see whether do we get any profit booking or a chance to enter. From levels closer to this 360 non-stop, stock has gone to current price of around 420, 425 zone, not giving any dip or opportunity to re-enter. But I feel you can start buying right now, and you get any dips to 410, 400 zone, add more, and I will be looking at targets of 450 for a short-term trade. But eventually stock is headed towards 500, available in futures. Look at long positions in DLF. For me, for a short-term trader, keep a stop loss of 415 and have an initial target of 450. But for me, DLF is further headed upwards. If you have that medium time frame, looks very, very strong.
I want to go back to that very basic point. What is the risk-reward ratio? Is the risk-reward ratio right now in favor of going long? Do you wait for that cut? My sense is that if you really wait for correction, there would be far more opportunity loss rather than waiting for the correction. I think we must recognize that a lot of problems or issues in the world, they're getting ironed out. Issue of US regional bank, impact of Adani fiasco on the economy and in individual lenders. What will happen to inflation, where it is now very, very clear and decisive that inflation is nearing a peak, at least locally, and Reserve Bank of India are looking at how crude and how other commodity prices have moved, may not be forced to increase interest rates. Monsoon, IMD feels that this year we could be in for a normal monsoon. So for me, if the moving part is monsoon and if rest of the market concerns are getting addressed, then it's time to really be on the optimistic side. The sectoral rotation is on. Banks are outperforming, consumer stocks are making a comeback, IT is where the underperformance is, and autos is where I guess the accumulation has started. So my sense is that this is a market where if you are participating more, you should be participating, you should remain invested, and you should have a positive approach rather than the temptation to really book profits. But Tata Power will be in focus, and Tata Power, after the center issued, has asked companies Mundra plant to generate and sell power under the Section 11 provision. Now, what is Section 11? I'm just going to share it for our viewers here. It simply means that as per the law or as per the clause, the government can instruct Tata Power to generate electricity, and Mundra plant is where they've not been generating to the full capacity. So Anisha, this entire force measure clause is at play now.
Oh, well, yes. So Section 11, as you pointed out, was implemented by the government last year as well, when they were talking about a supply crunch coming in for the power demand. And now, given the fact that summer is going to be scorching already, the government has clarified when it comes to the Section 11 applicability, because Tata Power had shut down its Mundra power plant on a temporary basis because there was a lot of under-recovery and overdues from the state discoms and generating companies. But now the CRC order has clarified whatever ambiguity was there, and now Tata Power is confident that they will be able to recover such dues from state generating companies and discoms. That is why it comes as a sentimental positive for Tata Power, and they have now started some of the units of the Mundra power plant already, and it's expected by that in a couple of weeks itself the plant will be able to ramp up fully, given the fact that the demand continues to be high. The street was worried that in the last couple of quarters there would be a bit of loss due to the under recovery, and that might mar the EPS situation. But now with this clarification coming in, question goes away. However, having said that, this is only a temporary relief coming in for Tata Power. The bigger issue is the supplementary PPA getting signed. It's been long overdue. The management was hopeful that it will happen in FY23. Didn't happen, but hopefully it will happen soon, because that means that could be a big re-rating trigger for the stock. In fact, analysts are pegging that there could be EPS upgrades to the tune of 45 to 50% if that supplementary PPA does get signed. But for now, at least, an interim relief coming in for Tata Power.
Okay, Tata Power is going to be the stock to look at for today. Anisha, thanks for those details. And with Pharma seeing a good run off late, here's another company which is now gearing up to hit the bourses. Mankind Pharma's first ever primary issue is going to be opening on April 25th. Somit is here with all the details. Somit?
Well, I'll start off with the IPO details. Firstly, if you see the price band for Mankind Pharma is fixed at around 1026 to 1080, that is the upper end of the price band, and the IPO will be starting on April 25th for 3 days and will last till April 27th. Now, the issue size of Mankind Pharma is completely offer for sale, where the promoters and investor will be selling their share worth nearly 4,326 crore rupees. Promoter will be offloading close to 1 crore shares, or shares valued at close to 1,081 crore rupees, while investors will be selling close to 3 crore shares or valued at close to 3,245 crore rupees. Now, the promoter holding, because of this offer for sale, will come down to 76.5% from 79% earlier, and the average cost of acquisition for the investors who are selling shares in this offer for sale, it was in the range of close to 276 to 550 crore rupees, which means that they're making healthy gains of nearly 2x to 5x their investment in Mankind Pharma. Now, Mankind Pharma, if you see, is the second largest pharma company in India in terms of sales volume, and it operates nearly 25 manufacturing facilities across India, and nearly 97% of its sales is derived from domestic segment. Now, if you see the market share among its consumer businesses, it has a leading market share with among the consumer businesses of the company. Now, when compared to peers like Sun Pharma, Dr. Reddy, if you see the company's EPS growth rate over FY18 to FY22 has been on the lower side, but the revenue growth rate compared to its peers is largely at par. Now, Mankind Pharma's revenue grew at a CAGR of around 12% over FY18 to FY22, while its EBITDA and EPS grew at a CAGR of nearly 18 to 21%. Also, the company's gross margins are leading compared to its peers. Coming on to the valuation part, now Mankind Pharma, if listed at the upper end of the price band of 1080, will be the 8th largest pharma company in India with a market capitalization of close to 43,264 crore rupees. And if you see its valuation, that is the forward price to earnings, now we have assumed a modest earnings growth rate of around 13% for the company, which is lower than what the company has grown around FY18 to FY22. But considering that modest growth rate of 13%, the valuations are kind of expensive at around 29 times as compared to the Nifty Pharma average P of around 23 times. However, if the company grows its EPS or earnings at around 20% growth rate, also the valuation would come down to around 27 times, which is still expensive compared to the average Nifty Pharma valuation, which stands at close to 23x.
Okay, thanks very much for giving us that insight as to what the valuation picture looks like for pharma companies. In fact, we'll take up that discussion with our guests soon. But in the meantime, shares of BEML land assets, they're going to be listed on the exchanges today. What does it mean for the shareholders? Let's find out. Sharad has all the details. Sharad?
An important listing is coming today, as BML's land assets will be listed on the bourses today, and overall if you see, the ratio has been given into 1:1 ratio for the shareholders when it comes to shares. Now, apart from this, what are the assets being divested? That would be in focus, and of course more than 1,500 acres of surplus freehold lands would be there in this asset pool. Apart from that, 124 acres of land in Bangalore and 401 acres in Mysore will also be there, and around 30 odd flats from the metro cities. Now, these are the land assets, but how the valuation metrics stack up, and as per the analysts, the new entity is actually going to mirror the current shareholding, And also there would be a huge value unlocking happening as sale of land assets take place between the government agencies as well as the developers. But now let's look at the value of land assets, and on 7 September 2002, as on the closing price, it stood at 1826 rupees per share, and ex demerger the stock price actually stood for BML at 1464 rupees per share. So during that time, the notional value or the indicative value of BML's land assets 362 rupees per share. Now, as per Antique Broking also, they have stated that the entire valuation of the land asset stands at indicative price of 624 rupees per share.
Okay, and policy bazaar as well in focus following the insurance regulator IRDAI's guidelines on expense of management. There's confusion over whether direct policies could see a pricing downtrend depending on the extent commissions paid to distributors. Now, this could in fact lead to a flare-up in channel conflicts as well. Vinny is here to tell us about how to ascertain the impact on stocks like PB Fintech, for instance.
Absolutely. Let's just talk about the new guidelines that have come in terms of that have come into place from 1st of April. And the concern was that whether these direct policies actually could see a reduction in terms of the pricing, and how will the commissioning also work out for these companies. Now, ICICI Lombard in its recent con calls and earnings con call which it had post its earnings highlighted that the new guidelines provided them some bit of a flexibility in terms of to insurance in designing the commissions as well as the reward to customers who are buying the direct policies as well, which makes it indicating that making it more principle based as well. So the new guidelines did provide some bit of a flexibility there. Also, they furthermore highlighted that they have actually been offering discounts of around 2.5 to 5% to customers who are coming directly as well, and that is what they expect to sustain going forward as well. So what this means is that now there's unlikely to be any material change, any major impact in terms of the premiums also, which was a concern, and that conflict and worry that everyone had, the fear on the street in terms of the pricing of these policies also is something that is clarified in terms of that as well, because there will not be any material change on that front as well. So this maybe will help settle the conflict, whether PB Fintech would see any impact of that, and obviously turns out a bit positive on that front. So we're keeping an eye out on PB Fintech as well.
All right, thanks very much for assessing all of those stocks that will be in the spotlight today. Meantime, let's hear it out from Vetri Subramaniam, CIO at UTI AMC. He doesn't see any major setback in IT as a whole, and he's going to look for buying opportunities within this sector. Let's also hear it out from Devina Mehra of First Global. She's overweight on industrials and capital goods, saying that stocks from these sectors have doubled and tripled from last year.
I've been tracking Infosys it's pretty much been a company that's been around all my career. And it's always had this habit of, surprising people very sharply, both to the upside and to the downside with their earnings reports. So it felt like I'd been transported back to another era when, the stock behaved the way it did. I think it's sort of early days at this point, Aisha, in terms of whether this is, company specific or sector specific. None of the commentary that we've been picking up in recent, weeks, months with the IT sector companies suggests there's, a significant setback at a sectoral level. And the company did call out some specific issues that they were experiencing. I think my operating premise would remain that, I think the IT sector is sort of emerging into the post-COVID era on a very strong footing in terms of the growth visibility that it has relative to the kind of run-up we had maybe during the period 2014-2020, which was a very sober era for IT, so to speak. So, incrementally, we would be a lot more positive towards IT. You're right about the valuations.
We have been very positive on industrial and capital goods for now over a year and a half. So from October 2021, and that's been a big performer for us because stocks have doubled and tripled also. And we still remain overweight, though. I mean, we've been booking profits. So last quarter also we cut a bit. This quarter also we cut a bit, but relative to the index, we are still way overweight. So that's a sector that we continue to like. We've done some reshuffling also, moved from, something where it looked like the move was over to something else. But that sector still we remain positive.
back with the market right here in 18 hour. The SGX Nifty taking a handover from the rest of the globe is indicating at best just a very, very quiet start. Yesterday, yes, sure enough, we did break that support of 17,700. But largely, you would have to say we were sideways and in a narrow band. The deeper damage, of course, came by only on Monday. When we got clobbered down thanks to IT. But yes, pharma is the one sector which has been sort of acting as a saving grace, not so much reliance ahead of its numbers on Friday. And yes, PSU banks and FMCG as well in bits and starts have been holding out. Let's welcome on board then Dipan Mehta and chat about what he's making of the market and various sectors in the markets. Dipan, hi, good morning. Great to have you on the show as always. Dipan, Mankind Pharma, an offering from the pharma sector after a while. Wanted to understand whether this is a subscribe or, a DHP that you're reading up on.
Yeah, good morning and thank you for having me on your show. Of course, it's a subscribe. I think the market and investors generally are very favorable towards consumer-oriented companies. And if you look at the pharma space, I think going forward, the best opportunities are going to be in the domestic market for companies which have got strong brands, distribution network, and feet on the ground to sell their branded products to the doctors, the medical representatives. And the opportunity overseas is gradually diminishing. It's getting more and more commoditized, not only in US generics market, but globally as well. So given this kind of trends and scenario, I think Mankind Pharma, which is a homegrown, largely domestic-oriented company, should be definitely subscribed to. Question is whether you will get an allotment or not because of the heavy oversubscription. But from retail investor perspective, it is a good opportunity, and perhaps you could even add some stock post listing. But from a professional investor's viewpoint, I think one needs to wait and watch for 2-3 quarters, let the valuation settle down, and then perhaps take a more informed decision.
What about the rest of the pharma pack as well, Dipan? Because while 2022 was a spree of underperformance from the pharma majors, barring I think a DRL and Cipla, which managed to do pretty okay. Sort of some buying interest seems to be coming back. The index is already lifted up about almost 9% from its 2023 lows. Wanted to understand whether you're scouting any opportunities here.
See, I think in pharmaceutical space, one has to be extremely selective, and even large export-oriented businesses, we are seeing a lot of variance in their performance. And some companies are doing exceptionally well depending upon their product mix and target market, and others are still languishing. And end of the day, it is a complicated industry to analyze, study, and invest in. As a thumb rule, as I said, I think we prefer domestic-oriented businesses. But on the whole, I would like to remain equal to underweight within the pharma space. Maybe 1 or 2 companies which come to mind, which are the market leaders, have been solid performers like Sun Pharma. Really appreciate their strategy of moving up the value chain into specialty products. That will make them stand apart from the rest of the crowd. And I think Divi's Lab may have seen a turnaround over there. It's exceptional. A manufacturing company with a very strong value proposition, and the custom synthesis business may have had a couple of soft quarters because of which we saw the correction the way we did. But the long-term prospects of that are phenomenal, and it's an India advantage company. So I think when the chips are down, you want to invest in a great long-term story, then Divi's Lab kind of meets that criteria. Apart from that, I think broadly we'd like to remain, as I said, underweight. It's a very complicated industry, and there could be a lot of volatility in earnings as well.
Okay, let's understand the technical take as well. And after a slew of underperformance that we've seen, Kunal finally seeing some sort of a comeback within the pharma names. How have you assessed these stocks on the charts, and which would be some of your top bets?
Yes, Avan. So I think Divi's Lab, of course, is one of the stocks which you recommended. Looks very attractive on the charts. In fact, on March, Feb end, when the stock actually formed a major bottom, hit that 2,800 levels, it managed to close a major gap for itself, and from those levels it's recovered more than 10%, and in a very slow and a gradual fashion. So I think that's a sign of a recovery which could probably sustain as well as grow for Divi's Lab. That's one stock which I would be keenly bullish on. Cipla has been the other name which I think closer to 880 odd mark is where we would give a contra buy. My expectation is that maybe the worst of the selling could be behind the stock. We've seen a very selling which had come back for supply in the last 2-3 months, where it had fallen more than 50 to 20% in a very short span of time. But I think close to that 880 mark, the stock seems to have found a major support, as well as it's gone into that fall, a price fall, as well as a time-wise correction. So that's also completed for supply, and that looks an attractive bet. The surprising stock from the entire large cap pharma name has actually been Dr. Reddy, because the moment the stock had broken past about the 4,350 mark, we've seen a completely different kind of a price action for Dr. Reddy. It was a very labored move for the stock. It used to move in a very slow and a gradual fashion, but the moment the stock had taken out this 4350 mark, 4400 levels, we've seen a completely stronger bout of momentum coming back into Dr. Reddy. Consecutive days of price uptrend for the stock. And I think just about last week or so, the stock saw a marginal retracement, but it managed to come back to that 4,850, 4,900 mark. So I think Dr. Reddy is also one of the other stocks which has already confirmed a breakout, which is going into a different leg of a momentum on the upside and could possibly lead the charge from the entire pharma pack in this leg of an uptrend.
All right, let's hear it out then from Pankaj Pandey, some of his top fundamental stock ideas.
So some of the names which we are liking is, one of them is Kajaria with a target price of 1310. One is we expect the gas prices to be softer. See, the margin profile for this company had come down to about 12%. Typically, the margin profile is in the range of 14 to 16%. We would expect those margin profile to sort of get attained in FY24. And on top of it, we are expecting about good low double-digit kind of growth in volumes. So that is one stock which we feel that the margin recovery would be the key theme to sort of watch out for. Another stock is Mayur Unicoaters. Why we like this stock is that the management is very confident of growing from, say, 800 crore kind of a turnover to 1,000 odd crore next year, and probably 1,100, 1,200 crore year after. It's a play on the leather segment, especially used in autos, where they derive 55% of the revenues, and the balance is coming from the footwear as a segment. So this is another company which we have been liking with a target price of 580.
Okay, those are some stock-specific ideas coming in from Pankaj Pandey. Let's take a look at what else is going to be in focus this morning. And we've highlighted as to how Tata Power as well has got some relief come by. The CERC has directed Tata Power's Mundra plant. The company has asked to comply with Section 11 provisions. So some bit of relief coming in by way of that. Tata Power is going to be another stock in focus. BEML2, the land assets are going to be listed on the exchanges today. Dipan, just wanted to understand where is it that you stand, when it comes to the entire PSU pack. And I'm going to talk about ex-banks, especially with the thrust on manufacturing now. And most of these companies fall within the PSU umbrella. Wanted to understand whether you find opportunities to buy afresh from the longer term perspective.
So I think the best space within the PSU is, of course, the defense companies and the shipbuilders. But these stocks have rallied considerably, and maybe if there's a pause or a slight correction, then they are like buy on dips. But by and large, I think they were really attractively valued on dividend yield basis and on price to earnings multiple basis as well. But now I think after the rally, they are kind of reasonably valued, but still they do have excellent earnings visibility. And these are good defensive plays as well, because in the market turmoil, I don't think that they will correct as much. So that's the best place to be in. Companies like BEML, Container Corporation, which may be on the divestment list. I think if there is a very specific diktat and they in fact do go for privatization, then that could be opening up a huge trigger for those two stocks in particular. But the track record on privatization front has not been that great, I think, except for Air India. No other company comes to mind per se. So I would say it's best to wait and watch the PSUs at this point of time. And maybe after the March results, you may have some surprises, because Jan-Feb March quarter also is exceptional for the PSU companies in terms of performance, seasonally strong quarter as well. So if you're a trader in string, then maybe the defense PSU stocks may give good returns in the short term.
Okay, that's the view coming in on some of those defense PSUs. What about Rudra, how you're tracking some of these names on the charts? Defense PSUs, the cynosure of all eyes. Do you believe that there's more steam?
Yeah, definitely some of these stocks can move up even from current level, but they have already performed so well and they have given that phenomenal return. I don't know whether from current levels, can you enter and see further more upside, and can that generate additional alpha what one is looking at? But still, definitely these are stocks much better to buy on any dips, and it can be definitely held for portfolio. So one can consider these stocks on correction to buy rather than buying at current levels.
Okay. Dipan, when you think that in the short term, defense PSUs can give a bout of outperformance. Now, when Dipan Mehta is talking short term, which means he's thought through something. What is that you know we don't know? And please share.
No. Good morning, Nikuja. I don't know anything which is beyond the public domain. My sense is that this earning season, you will see the entire capital goods manufacturing space really flower, and they should come out with exceptional results. It's easily a strong quarter, and operating leverages also will come into play. The order booking also will be at all-time highs, and the execution also typically because of year end, these companies tend to speed up execution and generate more and more billing. So I would say that in the entire 30-40 years I've been tracking the market, this would be the exceptionally great period for capital goods. And PSU defense stocks are in the nature of capital goods companies as well, except that they have a very specific kind of a product profile. So keeping that in mind, I'm very positive on that entire space, right from Larsen & Toubro, ITD, NCC, you name it. I think even ABB, Siemens, Thermax, all of these companies should report great results. There's always a bit of a kind of discussion on the price to earnings multiple and sustainability. But there's one trend across the board which I'm observing is that a lot of these orders which have come in the last 1 or 2 years, which are being under execution for the entire industry and L&T in particular, have come at decent margin profiles as well. So I expect the entire industry's ROEs also to improve, and that may perhaps give space for a better discounting. And what we like the best, of course, is the earnings visibility. And in a low to flat commodity scenario, these companies should be able to manage their operating profit margins very well as well. So that's one space where we have got our eyes completely focused on.
Interesting. GQG Partner have increased their stake in ITC from 1.2% to 1.4%. Now, GQG Partner has been an old India hand, but the name now resonates because they came out and they invested about 1.3 or 1.4 billion dollars into Adani group of stocks. Since we are with ITC, the 52-week change for ITC is 53%. Exactly a year ago, the narrative was it is in tobacco. The narrative was it's a challenging business because global funds will not buy into tobacco companies because of ESG restrictions. But guess what? If you look at the so-called labeled anti-ESG or the non-ESG compliant stocks, NTPC, Tata Power and ITC, they've given perhaps the best returns. Tata Power last 1 year, NTPC last 1 year, ITC last 1 year, and you will actually see that the returns Tata Power is not given actually. But NTPC is given good returns and ITC surely is given good returns. Depend on a traditional PE yardstick, ITC still looks cheap. It's nowhere close to the kind of P multiple, let's say, Asian Paints, Nestle or HUL is commanding. Is that the right way of looking at ITC? Because it still has a long way to go despite a 50% up move.
See, Nikunj, I got ITC wrong. I was negative on the stock right from last several years or so. And of course, we and our clients missed out on this superb rally. The logic was very simple that tobacco consumption was in low single-digit volume growth rates. Their FMCG business also, although it had generated a lot of volume, but if you compare their FMCG business in terms of operating profit margins, return on capital employed, any of such other financial metrics, it was poorly compared to some of the larger homegrown FMCG companies as well. And apart from that, they have the hotel business where there's a high degree of volatility. And clearly, according to us, the opportunity was if they were to split the three businesses separately, but I don't think that's on the cards at this point of time. And despite all the last 30-40 year effort of the management to diversify away from tobacco, that's just not happened. I mean, tobacco still is like 90% plus in terms of profits for the company. So looking at the full picture, we didn't think that the stock would generate sustainable long-term returns. But I think it was a value play. And as you said, I think, when there's an opportunity, that certainly outweighs any environmental or health concerns that investors may have. And it was a great dividend yield also at that point of time. And we are seeing this rally. But the question in my mind is that, is this like a kind of a one-time adjustment? Because going forward, I think next 2-3 years, again, if the profits start to flatten out, then again, you may have underperformance in the stock. So that's my assessment. But as I said, I've got it wrong in ITC so far. So please take my opinion with a pinch of salt.
Okay, fair enough. Let's hear it out then from some of our other guests. What are their top fundamental stock ideas? We keep that going. So here's Neeraj Dewan. What's he betting on? Take a look.
Yeah, the stock I want to recommend today is KRBL. So they are one of the largest rice millers and basmati rice exporters. So recently, we've seen a good build-up in inventory. The company procured 47% more paddy this year, and even the price has gone up by 15%. So the company, which is expanding into regional rice also, has announced a capex of about 250 crores approximately to be spent over next 2 years for increase in capacity of regional rice, which sells as a premium to the normal rice in the market. So the expansion in the margin will happen because of improvement in the price of the basmati that we've seen. Plus the growth will come because of increased inventory in basmati and the regional rice capacity which will come from this year and increase in the next couple of years. And plus the company has a Saudi business which was hit earlier because the dealer was not there. So they've not wanted a new dealer. So there's improvement in business from Saudi. Plus the company is even looking at appointing another dealer in Saudi. So there will be even continued improvement from the Saudi business. So all this together will translate into a top line growth of 20 to 23% over the next 2-3 years, plus improvement in margin that we're already seeing should continue over 22 to 24, about 470 basis points. So if I value this company at 11 times 1 year forward, I get a target of 415, which is the return of for 20% plus over the next 1 year. So I recommend this for investment for medium to short term.
I just want to revisit the story which erupted in the afternoon yesterday and then got dismissed in India or reported during the market hour, which is that government is looking at revisiting the entire tax structure for capital gains. The story erupted, a global media reported it. 3 o'clock we went on air and we said, look, it's nothing of that is happening. And now there's a clarification which has come from the income tax department. It's there on the website and on that Twitter handle, that there are no plans to revisit capital gains tax. And frankly, you think about it logically, if any changes had to be done, they would have been changed in the finance bill. It's not that changes have not been done in the finance bill. We know for the debt mutual fund industry, it's changed. Next year is going to be vote on account. And since it's going to be that general election year, which is 2024, next year's budget will not see any large tax changes as per the law because it's a vote on account. So from a market standpoint now, at least you pretty much know that long-term taxes will not be changed for a good 1 year plus. So that in a sense is a mighty relief for the market standpoint. So I look at it logically. For all the concerns which keep on erupting about the taxation structure for long term and short term will change, if I put two and two together, next budget is going to be vote on account, which will not see tax changes. Then there is a general election cycle. Then there is a budget after that. So looks like all the naysayers who've been talking about the tax structure which could change in short term and long term, they need to just take it easy now.
Yeah, absolutely, Nikunj. I think you need to keep to rest this argument, this news flow which keeps coming. One of the best things that the finance minister has done is given us stability in tax structure. I mean, whether it's corporate tax or personal income tax or even capital gains, the rates have come down, but there have been no major changes. And that really is very important in terms of planning people's business operations or savings for that matter. And now that everybody's going to the new income tax regime, we're going to see more and more money flow into perhaps equities and mutual funds, and there is no real reason to invest in PPF and Provident Fund and some of the other government saving schemes. So keeping that in mind, I think why would you disturb the capital gain structure? You are getting solid revenues from STT as well, and those rates also have increased. So I think we are pretty much stable when it comes to the tax structure. And every passing budget, the focus has been more on expenditure planning rather than tinkering with the taxes. And that I think has been the highlight of the Modi government. And we really, appreciate that kind of an approach. So I think they should be out of the discussion boards for a long, long time.
Okay, just taking note of some of the flashes as well. Sources on SCI, that's Shipping Corporation as well, talking about how the government is going to speed up the SCI divestment process. They are going to list the land asset company of SCI, and the financial bids can be invited in the months of May and June. This, remember, on the heels of the fact that you have the divestment of the land assets of BEML. Remember, today BEML land assets is going to be listed on the exchange. This is the non-operational surplus land, close to 1,500 acres that the company holds. And the total resaleable value of this excess land is seen between 3,000 to 4,400 crore rupees. So we'll be keeping an eye on some of these PSUs in light of that. Dipan, we got your take on that basket as a whole, but also curious as to where you stand when it comes to, the likes of Policy Bazaar, Zomato, some of these other new age tech companies. Just today you have the IRDAI guidelines on expensive management with some clarity needed, a PB FinTech talking about that. Any views on the same or these companies in specific?
So I think these companies are generally going as per plan. And their focus is now to turn profitable much faster and earlier than they earlier anticipated. It's the demand of the investors that these companies start to generate profits, and then we can start valuing them based on traditional valuation parameters like price to earnings, price to book. And I think they are clearly on that path. They have adequate cash on their books, which is perhaps a comfort for many investors. And genuinely new age businesses. A few of these will be really large companies in the 2030s decade. And if you have invested early in them, they could turn out to be fabulous multi-baggers as well. They are going about changing habits, changing consumption patterns, and they are themselves, large players or dominant players within the industry. And gradually they are creating a stronger and stronger moat for themselves. So our strategy is to buy them somewhat like options, have a little bit of exposure, 5-10% of your portfolio in such new age businesses. And let's not try and assess them or look at them every quarter, but give them a longer runway and remain invested and see how they are actually progressing. So we're generally positive, but as I said, I think you need to have a really long-term temperament for these companies and not get impacted by a lot of volatility which is there in their stock prices and maybe their earnings as well.
Okay, just let's get in a take then on some of the mid-cap as well as large cap IT companies on the charts. Given the rough few days that we've seen, although we did see some short covering yesterday, Rudra, what's your view on LTI Mindtree, Infosys, Zensar Tech, etc.?
See, I will avoid them even for some more time, might be another quarter, and then look at whether on charts I see that bottom formation and then try to catch. I don't want to pick a falling knife, but however, there are exceptions even in this mid-cap IT. I like stocks like Onward Technology. This has been one stock I've been following for a long time. I and my clients definitely have positions in the same from levels as low as 70 rupee. But even at current levels, if you see the chart pattern, last 1 week, again, this stock has held the strong bottom at around 290 zone, and again, it is bouncing back. So Onward Technology is one stock which is headed towards levels of around 450, 500, might be in a year or two, a good stock to own in portfolio, and it has performed exceptionally well irrespective of IT as a sector which has not done very well. But I feel right now, even if you pick up the larger ones like Infosys, TCS and all, they have come at attractive valuations, and I won't be surprised from here you may not find much downside, might be another 5-10% kind of a max move on the downside. These are times to now start slowly picking into IT as a sector, and you have to be very stock specific in it and see where you have comfort in terms of both valuation and even stock wise. You see the chart patterns where you have that bottom formation and then buy. Infosys for me might be another 5-10% down from current level, looks very, very attractive. And from mid cap, I like Onward Technology, and even few stocks like Persistent System, for example, looks very, very strong on chart. I will definitely look at buying even Persistent. So you have to be very choosy, stock specific, but now definitely you don't have any opportunity to go short in IT at current level. It is time to wait out for that 5-10% kind of a dip and start accumulating now and buy on that 5-10% dip more.
All right, let's just address then some of that news flow that we were getting a short while ago. The sources speaking on SCI speeding up the divestment process. It's an ET Now exclusive, and my colleague Prakash Priyadarshi joins in with all those details. Prakash, what exactly are you picking up?
Yes, sources are informing that government will speed up the divestment process of SCI from next month, and the listing process of SCI's non-core business will be initiated by early next month. Sources are informing that the land asset company of SCI will be listed, and the examination process is underway at the moment, and the government will initiate process after the listing of BEML's non-core business. So it will be priority for the government BEML's non-core business listing, and the divestment process of SCI will be initiated from next month. Apart from that, sources are also informing that the financial bid for SCI will be invited by in the last week of May or in the month of June, and the government is also hoping to complete this whole divestment process by end of this year. So it's a big development, and we can only hope that the government will initiate the divestment process by next month as far as the SCI divestment is concerned. Back to you.
Prakash, thanks a lot for that. IDBI Bank and SCI. For SCI, look, the financial demerger will only happen when the real estate is separated. And for IDBI Bank, things are at least moving in the same right direction, because now we understand that there are more and more bidders who actually are interested in buying for IDBI Bank. I mean, for the real auction process to go through, it cannot be done in isolation. So you really need to have a real scenario which perhaps will make the divestment process very, very easy. Dipan, whatever is said and done, when LIC was not getting listed, everybody said, okay, government is going slow on reform. They are not able to list LIC. When LIC got listed, it was very nicely priced. Everyone said that, look, this is a issue which is leaving a lot on table. But it's nowhere close to its listing price.
Yeah, that really is an enigma. And it's partly to do, I think, and it's my personal view, it's partly to do with the fact that LIC doesn't disclose its adjusted value in a timely basis. And that makes it very difficult to analyze, point number one. Point number two, I think it's very sensitive to stock price movements, much more than any other insurance companies. And since listing, I think we have seen the overall market trends to be on a declining mode as well. And that also has impacted the sentiment in LIC. And on the whole, I think insurance companies also have underperformed for various reasons, call it high base effect, call it competition, regulatory reasons, so on and so forth. So all of this, I think, has resulted in LIC underperforming. But don't write off this stock. I think it's a solid player. And at some point of time, once they start getting some of the more profitable products going and scaling up, you may see exceptional numbers coming through from LIC as well. Despite so many new players, they've been able to hold ground, maintain their market share. And as such, it is quite a well-run, well-managed company as well. And who knows, I mean, we had written off PSU banks and PSU capital goods manufacturing companies and defense companies 2, 3 years ago and see what kind of returns they have given. So why not give LIC a chance as well?
Give LIC a chance. Dipan, good to have you on board. Thanks so much for joining in with your take. Let's get in some mid-cap recommendations. What are the pre-open rates this Wednesday morning? For now, around 17,620 on the Nifty. For the Sensex, we're down about 125 points at 59,600 levels. Rudra, what's your top mid-cap call?
For me, Power Finance Corporation looks very, very strong on chart, and having given this breakout at around 145 levels first, the stock has now taken support at those levels, and again it is making that big move on the upside. For me, now this stock has strong supports at around 155, 160 zone itself, and it is now giving you an opportunity to re-enter again. So I will be a buyer in PFC, looking at initial targets of 200 with a strict stop loss of 155.
What about your mid-cap bets?
So, Aisha, it's a buy on Catholic Syrian Bank, CSB Bank, and as the NSE code goes, I think it's a very good recovery from 220 to 15 levels to 285. The stock is already at a 52-week high, trading with clear signs of breakouts, both in terms of volumes as well as prices. So, would suggest a buy. 300 could be an immediate target. 279 as a stop loss within.
Okay, let's also understand what's the buzz on D Street and what are the covers that we're picking up right now. Cement prices, it seems, have seen a hike of 1.7% on an average in the first half of this month alone. Where are cement prices headed and what's leading to this price escalation? Samit is here from our research desk to tell us more about that.
Well, if you see on a pan-India basis, the cement prices have been hiked by around 1.7% compared to last month. So the net hike is around 7 rupees per bag. Now that is the 50 kg bag that we're talking about. Region-wise, if you see in the southern region, the prices in Bangalore have been flattish, but in Hyderabad and Chennai, a 10 rupees hike has been effective. In eastern region, a net 5 rupees hike has been taken into effect, and dealers have been indicated that from May 2023, there could be another round of hike in prices. That's what the dealers have been indicated. In western region, if you see, Mumbai and Pune have seen a hike of around 15 rupees per bag, but in prices in Gujarat have been largely flattish because of a high base. When it comes to the central region, prices in Madhya Pradesh have been flattish, but in UP, some pockets have seen a hike of around 10 rupees per bag. And lastly, coming to the northern region, where the hike has been in the range of around 5 to 10 rupees per bag, but dealers have been indicated that this could be rolled back, and there's a high probability that this price hike could be rolled back in the later part of the month. Now, why is this price hike important for the cement companies? Because even in past, we have seen for the past 3 months, if we see that we have seen that cement companies have taken a price hike in the first half of the month, but the same was rolled back in the second half of the month to meet the sales target. So will this price hike sustain going forward, given the fact that the cost structure continues to remain elevated for the cement companies? So this is an important thing to track, whether the price hikes remain are sustainable or not, because in past 3 months the price hikes have not been sustainable. So will this 1.7% hike in pan-India basis will remain sustainable or not, would be important to watch from forward when it comes to cement companies.
Okay, Samit, we'll leave it at that. The entire cement sector is going to be in focus this morning. Let's also tell you what else has been making headlines. And Netflix delivered its first quarter earnings, which were mixed, a mild miss in revenues, which came in at $8.16 billion versus estimates of 8.18, so pretty much in line. The company has also delayed the rollout of its password sharing crackdown, which was originally planned for the first quarter itself. And Disney has planned another big round of job cuts as soon as next week. The company wants to slash thousands of roles, including around 15% of the staff in its entertainment division. The said job cuts will range from TV, films, theme parks to corporate positions. Also, hundreds of employees continue protesting against revised payout structures devised by the quick commerce firm Zomato-owned Blinkit. Employees believe the revised structures will reduce their earnings potential. The protests have gained momentum after garnering union support in the national capital. And back home, owners of cash-strapped airline Go First, the Vadias, have begun negotiations with strategic partners to sell a significant stake or completely exit the budget carrier. According to sources have indicated that the company is in talks with Pratt & Whitney to resolve engine issue supplies and seek compensation as well. And data coming in from the aviation sector, domestic aviation industry witnessed traffic soaring across the month of March as passengers traffic rose about almost 21.4% compared to last year. Meanwhile, Interglobe Aviation continues its dominance with its market share in March by increasing marginally to 56.8%, followed by Tata-owned Vistara at 8.9% share. And French Spirits Major Pernod Ricard has said that it will challenge the Delhi government's order to deny the renewal of its sales license. In a huge setback earlier, the Delhi authorities have rejected the company's application to renew its sales license on grounds citing ongoing investigations against the company. Also making observations in the same-sex marriage case, the Supreme Court cut short Centre's argument on value judgment and said that there is no absolute concept of a man or an absolute concept of a woman, and that gender is a subjective matter that was far more complex than one's private parts. The 5-judge bench said that it will not be touching upon the aspects of personal laws.
So Kunal, Nifty, it's going to start flat. Press the buy button, avoid, or press the sell button. What should one do?
For the Nifty, I would definitely be on the bullish side. Nikunj, I think if you open at 17,700, where we closed yesterday, 660 on the spot level, so maybe 17,700 on the futures, that could be a very good level to initiate along.
We got a bit of a divided house today. Kunal has a buy, Rudra has a sell, and Kush has a hold. I don't think there is any other strategy. Buy, sell or hold. Right, Kunal? One is a buy, one is sell, one is hold. There's really a divided house there.
Absolutely, Nikunj.
Rudra, why do you have a sell?
There is no trade.
Yeah, I mean, hold is don't trade actually, if you frankly ask me.
Okay.
Yeah, Nikunj, I think it can be only because of differences in time frame. I'm looking for a very short term. What has happened is in last 2 days, we are seeing FII sell, and more than that, I even mentioned, for me, this is a buy on dip market, but however, 1,000-point rally has happened in Nifty in just last 9 trading session. So I'm expecting a small mild correction which can come to levels closer to 17,500, 550 zone in future. Until then, if I have to be a buyer, still I will look at buying stocks from Pharma or even from real estate. So it is just a call on Nifty because that resistance at around 17,800 in future has been tough. Last 2 days it has taken that resistance and it is seeing some small profit booking. So still I say it is a buy on dip market, but for very short term, might be next 2 days kind of a view, we might see some profit booking and 100-200 point kind of a correction cannot be ruled out. One has to use that as a buying opportunity, and at current levels I will not be a buyer in Nifty.
Right. Okay, getting set for the market open. No consensus call when it comes to the index. Kunal has been maintaining that it's going to be a very lackluster week because you've got 2 fat numbers coming in which are only going to come out post Friday, post markets on Friday, that is. That's Reliance as well as ICICI Bank. And wonder where directionally the market in the near term is going to be headed. I think we're falling prey to earnings as we've seen that in the case of IT numbers.
Aisha, markets were extremely oversold. From there, you've neutralized. Remember the pendulum example which we spoke about, that in the market, the pendulum will always swing. You were in an extremely oversold zone. You've come to the neutral zone. You will move to the overbought zone. I don't think you are there yet. But then in the interim, when you are coming from an oversold zone to the neutral zone, the market and traders and the HNI investors would be convinced about coming back into equities, and you can see the block deals and the bulk deals and the HNI disclosures which are coming out. Now that the quarter end disclosures are coming out, whether it's a Vijay Kedia or an Ashish Kacholia, whether it's a Dolly Khanna, Mukul Agrawal, the HNI investors have been shopping. And they've been shopping when the market, in a sense, is looking to consolidate. So I think you could be in a scenario where the Nifty may just hit a pause. It could just do nothing for next couple of days. But the energy and the inertia in the mid and the small cap space, I think, is very, very profound and very, very well defined. Look at the profile of stocks which are making a new high. ITC, bolt out of the blue. L&T, the real leader in this market, so to speak. Banks are holding on very smartly. So what IT is a bit puffy-duffy and it is shaky. I think the rest of the market, which is a combination of defense names, capital goods stocks, ITC, L&T, even for that matter, Reliance, which is showing signs of energy now, the market is not looking bad at all. So you need to be an optimist in this market. You need to approach this market with the view that you will get higher levels in coming days and coming weeks. I think if you wait endlessly for that big correction, then I think that big correction may not come through, at least in the current circumstances. Individually, it becomes a very different judgment call, but I would say if you have to balance for a trade in the short term, I think it's Pharma. Whether it is valuation or under ownership or what is happening to the US generic pricing and the domestic pricing, I think Pharma has got all the necessary ingredients where you could actually see domestic pharma companies to outperform. So the buzzword here is Pharma. Within that, you want to add the word domestic pharma companies. First rates will just start coming up on your screen. First rates any second now. You got a flat start for the Nifty and a flat start for the Sensex. Not too many newsmakers, I'm afraid, so it's not going to be news heavy Wednesday morning. But you got a 13-point cut on the Nifty and you got a perfect market breadth. HCL Tech is powering along smartly, UPL is powering along smartly, Apollo is looking strong, HDFC Bank is recovering from that abyss it had hit on Monday. So it's a good start, it's a decent start, and it's a start which just does not change the big picture, so to speak. I want to look at the real heroes now. Tata Motors has been a very smart outperforming stock. Has Tata Motors picked up from where it left yesterday? It's not a bad start. IDFC Twins, again, this is where the market direction has changed. RBL Bank, suddenly markets feel that all the concerns are behind. So RBL Bank yesterday had a good start. And then let's not lose sight of Yes Bank, which yesterday, being a two-digit stock, got a lot of action and attention. Yes Bank is now 16.5. 22 became 13. 13 has become almost 17. It's been a good comeback for Yes Bank from the recent.
Let's see what Tata Power is up to. Considering they've got that temporary relief coming in, that stock will just come up for you on your screens. Remember, the centre has issued and asked the company's Mundra plant to generate and sell power under Section 11 provision, so that acts as a bit of a relief. Although you're not seeing a reaction of Tata Power, still flat as we speak right now. Pharmaceuticals, that's the one space which has been a buzz. There's Mankind Pharma IPO as well, which is going to open on 25th. Lupin, Biocon, Divi's, Cipla, they all were holding a buzz in trade yesterday. Today, it seems like they've hit a bit of a speed breaker. Zydus Life, they've got the final US FDA approval for one of the transdermal systems that they've been working on. That stock not seeing much of a reaction. Piramal Pharma, though, has got the US FDA issued an EIR for its Sellersville manufacturing facility. Piramal Pharma gaps up about 4.6%, 75.22 is where that stock is. There's Bank of India as well. Is approved fundraising of about 6,500 crore rupees for FY24. Bank of India 1.25% higher. There's eClerx as well, which has appointed Kapil Jain as CEO of their UK subsidiary from May 1st. Now remember, Kapil Jain actually comes from Infosys. So in that sense, eClerx, a stock in focus, holding up 1.5% as we speak right now. The government, remember, has increased the windfall tax on crude to about 6,400 rupees per ton from nil. That would not spell as good news for ONGC, but good news for Reliance Industries. So both those stocks in focus right now. There's also ICICI Lombard, wherein the net earned premium has come in below estimates. Tata Coffee, the EBITDA for the fourth quarter is down 5%. Margins have slipped more than 200 basis points as well. So these are some earnings disappointments coming in. But Kunal, for the index, it's absolutely flat. What do you do next? What trades are you punching in?
Well, yeah, Aisha, I think it's going on expected lines. That we expected the indices to remain flat over the last couple of days, and that's what the indices are doing. In terms of individual stocks, there are, I think AB Capital is something which I've highlighted last week as well. Looks extremely attractive. The stock has managed to dip back slightly from that 166 levels to 163 yesterday. So that's an attractive territory where I would look to buy. I think it's a very attractive chart. The stock has confirmed a breakout on multiple time frames, so that's a stock which I'll look to buy.